Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hello everyone, I'm Ed Gotham and welcome to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Today I welcome Keith McCullogh, the founder of Hedgeye Risk Management, which is a no-excuses provider of real-time investment research and a premier online financial media company. Keith and his team of 80 analysts are hard at work tearing down the edifice of old Wall Street brick by brick. We deconstruct the proprietary models which Hedgeye use to both assess the markets and recommend positions. This includes his quad-based investing approach, risk ranges, and even portfolio and position sizing. We also discuss what quadrant we're in today and what that means for investors. I had a lot of fun talking to Keith. He's developed his unique approach to the markets by analysing a huge amount of data. Fundamental data is at the core of his strategy. His insights are really second to none. Enjoy. Hi Keith, great to have you on the show today. It's been a really good process to get to actually meeting you and actually been one of the most interesting people that we've had on the show, I think. So it's great to have the opportunity to go into depth on your process, especially in a world where we've had a lot of technical analysis on the show, and it's good to get the other side of the coin, if you like. How are you?
Yeah, it's good to be with you. Thanks for having me, and thanks for having some interest in not only my process, but it sounds like having some interest in how I go about it.
Yeah. I just wanted to kick off because we just want to get people interested in the show from the get-go. And Hedgeye's mission, I just wanted to ask what that is, because it's a really interesting sort of way it's come about, and it's sort of the anti-Wall Street, if you like. I don't know if that's the right way to describe it.
Yeah, I think that would be an understatement. I think we affectionately call Wall Street the old wall. So, we have our friends and foes associated with that. But, the mission is really to make the process of investing, particularly from a hedge fund manager's perspective, or now what we call a full investing cycle asset allocation perspective, which sounds like a lot, but it is a lot. And I think that people would prefer to have a transparent, trustworthy, and accountable platform of content and a process to communicate that. So that's really the mission, is to show people how real people manage real money. And it stands in what we think is sharp contrast to what people are used to receiving, which are the inherent conflicts of interest of the old wall, whether it be, it's compromises, it's investment banking, it's broker dealers, et cetera. So we're an independent research platform. The idea with Hedgeye is that you could, quite simply, if you could look inside of a hedge fund, what would you see? And that's why I put an I on the end of hedge, and it's Hedgeye as of 13 years ago. Yeah.
And the basic premise is it's hedge fund quality research for the sort of retail investor. Is that the right way to describe it? Or?
Well, I don't think it's for it's for anyone. We basically try, and that is part, I suppose, an important part of the mission as well, which is to democratize what really only institutional investors had access to.
Yeah.
And we have a large and growing audience of what you might call retail subscribers or whatever. But what we're learning is that they're quite sharp, and they know what they're doing, and they're looking for a better way too. So we have both. We have, the largest hedge funds and mutual funds, pension funds in the world as clients, but we also have our daily product, the macro show, fully loaded, real-time alerts and all that is, we have a lot of individual subscribers as well.
And something you're renowned for is #timestamped, and you're able to quickly tell us about that.
Well, timestamping is as old as the game itself. So, really what I was trying to point out there is maybe a lack of timestamps from Wall Street. So whether you're watching CNBC or you're watching something, whatever it is, there just seems to be a suspicious, maybe not so suspicious anymore, lack of timestamps. And so again, if something's going to come out of your mouth or out of your fingers, and now on Twitter, I would suppose that people would prefer to have a timestamp on that. So what we do is, again, try to make everything we do, like buy or sell this or that or the other, make it as transparent as you can, and the timestamp's the best way to do that.
Yep. And quickly, just before I move on to get a bit more detail about how you got to where you are, because I follow you on Twitter, and I just there was something you posted today I wanted to quickly talk about. You said, or I think you wrote down somewhere, but someone retweeted you retweeted it. I understand that sometimes I should only like a stock if it's expensive, and really like a short if it's cheap and getting cheaper.
Yeah.
And I just thought, could you quickly just tell us about that?
Yeah, I mean, Ed, that took me a long time to appreciate. I mean, me as the, I guess, the unaware, when I was initially an analyst on Wall Street and then trying to understand how to run a portfolio or a book at a hedge fund, I mean, I thought that you were supposed to do it the other way, which is just short expensive stocks and just buy cheap stocks. Now, that, of course, doesn't work. Maybe using the words "of course" doesn't become readily apparent until you screw it up enough times. But I mean, what we've realized is that economic conditions perpetuate more expensive stocks getting more expensive and cheaper stocks getting cheaper. So a good example of that, and I'm sure we'll get into it within the process, is when you have like quad 4 economic conditions, i.e., deflation, growth and inflation slowing at the same time. What gets really, really expensive are long-term bonds, utilities, gold, things like that. And people are quite uncomfortable with that because most people didn't own those things. So they're, of course, poo-pooing them because they go up, up, and up. And then nowadays, when we're in quad 2, it gets super expensive are growth stocks. So again, growth gets more expensive. And I say, look, if it wasn't getting more expensive, I suppose I wouldn't want to own it.
Yeah. Okay. And so are we saying this concept of value, the traditional sense of value, is in stocks and how they're valued? Is that less important now? Is that what you're saying? Or?
It's always been that way, actually, if you look back historically. I mean, the cycle has a central tendency to just pound cyclicals when you're in an economic slowdown, and of course, when you're in an expansion, you get bubbles. So, I mean, it's always been this way. I just think that we're one of the few places that articulates going both ways. Like, again, I don't care if I'm long growth, value, growth at a reasonable price, momentum. I want to be right what's going up, or rightly long what's going up. And I think that that's something that takes you a while to get comfortable with. Maybe that's why some of the quants, like, if you look at Jim Simons at Renaissance, he really doesn't ask why, or he doesn't care what the multiple is on a certain stock. He just owns it because it's going up.
Yeah, fair enough. And just going back to a bit of your history, you got Selective Wall Street because you're a hockey player, as far as if I'm getting through your background correctly. Is that right?
Well, that's how I got my first crack. That's for sure. I was lucky enough to get my first job on Wall Street or internship from a former captain of the Yale hockey team, and I had that in common. So I had my first shot at learning what I don't know, and from there on in, I had to make my own way.
Is it right that he specifically sort of looked for hockey players though, because of the traits that they had? Is that right?
Yeah, that's right. He would always joke. He said, "Hey, there's a difference between hockey players and figure skaters," and I know that doesn't make every figure skater happy. It's just what he said. I didn't say it, but I don't disagree with there are certain attributes of a hockey player that can be quite useful in a game like this.
Which ones but can you, what sort of attributes are we talking about?
You have to have a short memory. That's certainly one. You have to be able to take a punch. That's definitely one. You have to learn from your mistakes quickly. You have to have some mental flexibility, or a lot of it. I think being, more of like, being dogmatic or intellectual or whatever, you have to, in your own mind, be right, really poses a lot of problems. And I think that just growing, and it's not just hockey players. I think it could really be any sport where you're constantly facing adversity. I think that absolutely prepares you to not only trade markets, but analyze them and over time, have an ability to exist or stay in the game, so to speak.
And so, is your office full of hockey players now, or?
we have some, but we have about 80 people, and
80.
I think and if you took a picture, there are plenty of pictures of floating around, I suppose, these days of, whether they be our holiday parties or whatnot. What you find with Hedgeye is that, everyone looks different, and they have one simple thing in common, which is, their principles, and being transparent, accountable, and trustworthy is a big part of that. So we have, all sorts of people here. Quants, we have data scientists, we have artists, we have journalists, we have me. I'm a bit of a, I guess some people call me a lot of different things. So we have a lot of different flavors here at Hedgeye.
I hadn't realized quite as much before going into detail before this that you had so many people that work for you Actually, the figure that's quoted in a lot of places is 40 plus, but I didn't. 80's double that, so that's huge operation. You must have been growing quickly over the years, and also you don't do any sort of managing of funds at all, do you? As far as I'm aware, it's all focused on the research, the analysis for your subscribers.
Yeah, it's purely structured as what we call an independent research company and now media company. So we do actually, and that provides for a lot of, over the years, I didn't know, what I was getting into. I just kept building it. And, what you find is not being a broker dealer and being a media company provides for tremendous advantages in terms of like daily communication. Like I can go on Twitter and say whatever I want, whenever I want. Whereas if you're on a desk somewhere in London, trading for whatever, you're at Goldman Sachs, just to use an example, they can't do that. So I always say to my team, I say, hey guys, look, at a bare minimum, we're going to be faster than everybody else. Now we got to focus on being right.
Yeah. Okay. And in between, so you got into Wall Street after being a hockey player. And then what was your journey that got you to Hedgeye? Because that was quite interesting as well.
Yeah. So I did I had a successful experience as a hedge fund analyst. And then they, like most hedge fund analysts that are successful, they turn you into the portfolio manager. And then I had success as a portfolio manager. Then I ended up being, I think, one of the younger portfolio managers at Carlyle on their new hedge fund, which was in 2007. So I got that job, and I thought it was the greatest job I was ever going to have, Ed. And managing, whatever I could, the sky was the limit there. And within a year, we blew the place up. I mean, I didn't personally blow it up, but our credit guys did. And it was a multi-strategy hedge fund. So we were done. And I had just basically a non-compete. So I had to sit on the bench, so to speak, or in the garden, wherever you want to go. And I just came up with the idea of Hedgeye. I mean, I had actually gotten fired when on November the 2nd of 2007. I remember that date, not because I was fired, probably a little bit, but I mean, my first child was born, my son Jack, or John Henry is his proper name, was born on November the 7th of 2007. So, you go through that period in time in your life where, I did at least, where you have a child you need to take care of, you're there with your wife, and you're like, wow, I just better not ever get fired again. So that was... I thought a lot. It was a very introspective period, in like 3 to 6 months in my life. And I said, I'm just going to hang up my own shingle and do it my way. If I'm going to fail next, it's going to be on my own watch. And, thank God I didn't.
Yep. And so, you got fired and then you started Hedgeye. And is there, from your experience now at Hedgeye, is there some sort of key thing you've learned, do you think, about the markets that you just weren't aware of prior to that?
I think, I'm more aware than I ever have been that the game and markets are constantly changing. So to be with all the humility that's possible for a human being, be able to change what it is that you're doing and be able to get rid of things that you used to think within your process, or I guess some people operate with belief systems, just don't have one of those. Have a process that you can evolve, tweak, constantly back test in our cases, and look for, the next path forward. Because the game is it's never going to stop changing. And the minute that you think that it's done changing is when it's right about to change again. Yeah.
Awesome. I think we can move on now to your, some of the proprietary models that you've developed at Hedgeye, some of the most interesting stuff. The quad-based investment approach, which you talked about, you're a big advocate of the numbers, not the narrative. Mm-hmm. And this quad-based investment approach, or the GIP model, is that how you?
Yeah, the GIP model. Yep.
Inflation and policy. Could you go into detail on that and give us an overview of what it is?
Yeah, sure. So there are two big components to the process. There's the signaling process, which we can go through, and then there's the fundamental research model, which we call the GIP model, or as you pointed out, the growth, inflation, and policy model. Then we can get into it if you want as well in terms of company models, what we call our 3-pod model. But again, we have models basically that we start with as reference points for everything. But the growth, inflation, policy model is set to, it's designed to basically front run not only markets, but central bankers. So what you'll find is that both the rate of change, which is how we model it, using the second derivative, or if you map it on a sine curve, what we're trying to do is front run the next move in growth and inflation at the same time. So the 4-quadrant model basically takes two key factors, growth and inflation, and looks at it on a year-over-year basis, and then looks at it also sequentially to make sure that we're not missing the broader move. So what you end up with are 4 economic scenarios. So it's like a 2x2 model. You have quad 1, which is where you have growth accelerating on a real basis because inflation is flat or falling. Then you get the economy gets really hot, like it is right now in rate of change terms, and you get into what you call quad 2. That's where the rate of change of both growth and inflation are accelerating at the same time. Then you get into economic stagflation, which is quad 3. So that's where inflation is accelerating, but real growth is slowing. That's really damning for human beings. That's what we had prior in the US and a lot of economies for that matter in Q3 of 2020. We've subsequently come out of that. And then there's the worst, which is quad 4, where you have both, like I said, both growth and inflation slowing at the same time. That's where everything goes down that was expecting otherwise, and the things that people really don't appreciate as much as they should. When you have those quad 4 conditions like long-term treasuries, basically it's deflation, right? So that's, to name them, quad 1 and 2, the sun is shining, and quad 2, it's shining really bright, and everybody's participating in the party. Then stagflation comes, and not so many people are doing so well in life, but the people that have all the assets are doing quite well because they're just front running inflation, and then you get the big deflation, and then everybody's pissed off.
Okay. And this is almost the starting point. It's your lens that you look at the markets and decide where people should be focusing their efforts. Like, you shouldn't be looking at anything else. This is the stage 1, know what quad you're in, basically.
Right. Well, most importantly, know what quad you're in and going towards, so that's, and some people struggle with that. Some people don't. I think it depends on what your flexibility is in terms of change. I mean, if you wake up every morning just, embracing uncertainty and accepting that you don't know what's going to happen next, this is a very good, what we would call a Bayesian inference process. It's a stochastic modeling process as well, just to kind of get into the specifics, where again, every data point economically can ostensibly change the direction. They don't have a central tendency to do so. They have a central tendency to trend. That's why, again, front running big turns like that, whether they be in growth and or inflation or both, they're really important to stay ahead of. I mean, Ray Dalio's proven this over the years with Bridgewater. There are plenty of quants that have proven the same. Growth and inflation on a trending basis is as causal as it gets. And are these quads, does it always go sequentially, or can you move back from quad 2 to quad 1? Is it? Yeah, anything can happen. What's typical is that that anything doesn't happen. This year, a lot of things happen, right? So when you get a lot of volatility economically, and from a market perspective, the quad, you jump around, because you have, think of it this way, anytime the economy gets into quad 4, the central banks print money, and now, as far as the eye can see, reinventing, or I think they call it innovation, innovating ways that they can save you from, God forbid, markets going down, growth and inflation going down as well. So that's the thing. Every time you hit a quad 4, there's, since I started doing it this way, I mean, there's more of a panic and a dependency at the same time, a panic by markets and a dependency by market players to get that cowbell, to get the Fed or the ECB or whoever to come in. So what happens is that you don't spend a lot of time in quad 4 because shit hits the fan in quad 4 very quickly, i.e. the most amount of people get caught off sides at the same time. And then there's a literal begging for the socialization of markets, so to speak. Mm-hmm. So here you have a very quantitative approach, but I'm giving you some real words and feelings to think about why it is that the machine is triggering and going to the next quad. Yeah. When you come out of quad 4, just think about it this way: it's deflation. So you're either going into quad most of the time, and it's not all the time, but most of the time you're either going to quad 2, which is great economically, or you go to quad 3, which is bad for a lot of people. It's stagflation, because what the central bank, to use the case of the U.S., what they're doing is they're saying, I'm going to devalue the currency so that I get the prices of assets in a devalued currency to rise. And if you have too much of that, or the people have to pay more of the price and they're not getting their job back, that's stagflation. They're paying, their cost of living is going up in devalued dollars. Whereas if they're getting their job back and the economy actually starts to hook up, and then everybody's a winner, and that's quad two. So, that's actually where we think the economy is right now, and most importantly, discounting we're going to be for the next at least 3 to 6 months, and then after that we'll have to see.
Yeah. Okay. And so, from an investing perspective, what does quad two mean for the investor then? What should they be looking at? What should they be focusing on or not focusing on?
Well, one thing, I focus on everything all at the same time. So, when you have an approach like this, you have what we call multi-duration. So you're looking across durations. So I call them trades, trends, and tails. So short-term, intermediate-term, and long-term. Substitute that for trade, trend, and tail. Then I also use a multi-factor model. So I'm looking at a lot of things across 3 specific durations. And, so I'm looking at everything all at the same time. I think that's what you should do every day that you get up. When you look at my Twitter handle, what you'll find from 4:30 in the morning, East Coast time here in the US until the market opens is I'm just systematically giving an update on what's changed, if anything has changed. And most of the time markets are changing. So, that's what we're talking about there. But like when you think about it from a multi-factor perspective, what happens in quad two is that people that had the deflation or duration portfolio, so you're, like I said, you're long, gold and long-term treasuries and utilities, basically anything that's interest rate sensitive, a bond proxy, you really start to lose your money. And that's a problem. What really works are things like commodities, growth. So again, a lot of most sectors, cyclical and growth-oriented sectors of the stock market work. Small caps really work really well. So people look for more and more higher beta ways to play, or higher leverage, high short interest. So what you'll also find is like a lot of quote unquote garbage really rallies. So that's what we have right now. And I think that quad two, when you come from a pervasively deflationary environment, really gets people stuck, in their prior dogma, if they had one, because some people are just permanently bullish of certain asset classes because they're either marketing those asset classes or get paid to only be long them. So this is where, our model will say, no, we're actually going to buy, like if you take the 2 quads, Ed, that are the opposite of each other, it's quad 2 and quad 4. So basically what I've done in the last, going back to June 1st, on the inflation side, because it was quad 3 and then we've gone to quad 2. By the time we got to quad 2, I'm basically long all of my prior shorts, and I'm short all of my prior longs. So that's where some people just can't handle that. I get quite excited about it because at least there's some change in my life.
Yeah. And how have you determined what is good in each quad? Because it would make sense, but
yeah, we backtest literally everything. So we take anything that ticks, and now that includes things with some things have a shorter time series or a shorter history. For example, Bitcoin, where you don't have the history of volatility and options trading. So you can't backtest it as well because you just don't have as much time and space. But that said, what you'll find, and it does irritate people that are permanently long of Bitcoin, that quad 4 is bad for Bitcoin. We're not in quad 4, so they can take their earmuffs off, when I say that. But the reality is that all I'm really doing, I backtest cattle futures, Bitcoin, the S&P 500, the FTSE, we just backtest everything against the quads. And what you find is that, against each quadrant, something has a certain expected value. We look at it quarterly. So it's not like, what is the quarterly expected value of every single thing that ever trades by economic quadrant? And that's our starting point of awareness. That's just like what I would consider, and at the beginning you asked me, like, what do you know today that you didn't know then? I didn't know that back then. Like when we started Hedgeye, I would prefer to know that. It's just like having a map. It's just what actually happened. It's not an opinion of what happened. It's what happened. And I'm very comfortable being uncomfortable with that, because a lot of people start their day or their investment position with the way the world should be, could be, would be, politically, emotionally, valuation, all these different reasons why. I get it, but they don't even start with where we came from. And I think that's a really tough place to start, or at least it would be for me. I'd struggle with that.
And because what you find a lot, at least from my experience with statistical models sometimes, is that there's not really a big positive or negative correlation in these different, like when you're looking for something. And so when you're looking at, you're saying tech stocks or growth stocks are good in quad 2, your models have found a really big correlation with that sort of happening. Is that right?
That's exactly right. And what we try to do is not only a high probability of happening, but high percent positive ratio, things that you look for. Like, so what we and again, this is just a starting point, right? Like I said at the outset, there are two major components to my process. There's the signaling process and the quads. The quads just tell you what could I like in this quadrant. Just giving, this is where I'm a Canadian fisherman, so I'm not a very good one, but I'm probably better at my day job. But this is where there should be fish. This is where we caught them before during these conditions. If you go there and it's January the 10th in Thunder Bay, Ontario, where I'm from, you're going to need an auger and a snowmobile. So the conditions have changed versus July. So and it's actually a very good way to think about and a lot of our clients have said that the 4 quadrants are like the 4 seasons. They are in the case of winter and summer, using the fishing analogy, they're dramatically different, economic circumstances. So, it gives you your initial Bayesian inference, this is where we should be. And then you use the market signal to enhance, okay, what is signaling with more strength or less strength, where that, use a fish finder, for example, is the analogy with the one I'm working with here. Okay, there's the fish. I actually see it now, right on the edge of the boat. Like I can actually see its fins, okay, that's a pretty strong signal that the fish is there. And we actually have those right now. Like we have the S&P 500, for example, has a 15-day inverse correlation to the dollar of 0.90. And that's about as close to the fish as you're going to get. So, and guess what? The dollar back test says it's negative. It has a negative expected value in quad 2, not surprisingly, and that perpetuates, asset price inflation, commodities and stocks. And so what I see every day, like I'm fishing and you're actually catching and eating the fish. So it's not exactly going to say that you should stop due to valuation reasons or something like that. You just keep on fishing.
Yeah. No, I think it's really interesting. And I think it's once you've got it through your head, it is actually a complex, but it's a simple way of looking at the markets. Really helps you define your process and what you should be looking at. I've enjoyed going into detail on it. And today you actually said, I just wanted to ask why it's the best day ever to improve your positioning in quad 2. Why is that?
Yeah. Well, every day is. I mean, really, every day is the best day. I mean, and I like to think of trading. If you're going to actively manage your portfolio, and some people are like buy and hold, and I get it. It's a lazy way to invest. Eventually, God willing, you're going to be right on whatever it is you bought, provided that you didn't buy it at the high of the cycle. So that's fine. But for the rest of us mere mortals, we're going to wake up and we're going to tweak and trim, or like I like to say, I like to prune and plant every position in my portfolio. So if it were to go up a lot last week, then I'll some Russian stocks, for example, they went up a lot last week. You sell some of those, and today is the best way to improve your position because you take what you sold there and you go buy energy. In the U.S. is for sale today for the first day in a while, so you can buy more of that because you sold some of that last week too. So every day you have an opportunity to, I like to think of it this way, Ed, which is, okay, we only have so many dollars or so much capital. I mean, what is the best place for your capital, the most optimal position for all of your capital to be deployed today? And if you start to think about it that way, I think you're going to not only be focused on the most important rule in capital management, which is preserving your capital, don't have drawdowns. And the second most after you've done that, which is compounding returns. So the best way to compound returns is to move. If you just stay in one thing, there's no data to suggest that staying in one thing forever is going to lead to the optimal or to the best alpha over time. And that's how I think about it.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
How do you know when to get out of one thing? Or what? So do you think Russian, when they have too far of a move, is that then it's right to go into something else? or?
Yeah, I definitely, I'll tell you what I don't do. I don't do what I used to do, which is use some bloody chart or some valuation study. And a lot of people that upsets them because they're like, well, that's what I'm doing. It's okay. It's okay. Like most things, I think when if I were to trigger somebody's belief system or something like that by saying something like that, valuation is not a catalyst, or I don't look at simple moving averages of stocks. That would be a one-factor model, which would be completely useless on any backtest that I've run. What I'm really doing, so I have a process called the risk range process. So the risk range process is a daily, that too is quite literally your fish finder. So it tells me every single day, the machine does. The only thing I do to the machine is change the volatility assumptions and the duration in the model. So, what it gives me in the morning, again, it's not a qualitative or either a qualitative or a valuation-based opinion, is where is the new range? And if something's at the top end of its risk range, then I'll sell some. I won't sell it all. I'll trim the position by 25 or 50 basis points of the position to start. And then if it's up even more by the time the market, opens the next day, I'll sell another 25 basis points. Okay, so it's a way to... It's actually, I built it that way because it saves me from having to guess, which I don't guess. And I'm always, paying taxes because I'm constantly booking gains. But I'll offset those taxes by stop losses in things that don't work. So, whatever. But, every single day, that's the only way I make that decision. And that's why at the beginning of our conversation, when you said, can you say that again about expensive gets more expensive? The most frequent mistake I've ever made, and I'll make it until I'm bloody well dead, which is kind of amazing to know that I'm going to keep screwing it up no matter what process I build, is that you sell too early, right? You sell your winners too early. And so I built this process so that I sell some after a big move, but don't sell nearly enough of it for me to look as bad as I can if the thing goes up another 20 or 50%. Yeah. And I'm always buying it back on the corrections. So it's been a better way for me to solve for one of the bigger problems that I had as I guess I'll call myself a younger man in this game, 20 years ago and 15 years ago, 10 years ago. It's 10 days ago, I think I made that same bloody mistake. So that's why I built the risk range process. That's
really interesting, actually. That's because it's a bright time to move on to this then, because I know you're a big advocate of repeatable risk management, and that's, I suppose, where the risk ranges come in. Can you talk about your quantamental risk management process and how that includes the risk ranges, etc.?
Yeah. So I mean, again, the quads are ostensibly going to tell us where we're headed, and the market signal, which is what so let's call the quads fundamental data, because that's fundamental economic data. There are 30. For example, in the U.S. model, there are 30 economic data points in the model. It's a predictive tracking algorithm. So you get 30 data points per month, 90 per quarter. Those all change all the time. And then on the other side of it, the quantitative risk management side of it, which I call the signal, is our trade trend tail signal. So again, these are signal levels that are fully loaded, that have built basically to use a basic component of the model. It's in terms of construction, it's price, volume, and volatility, with a heavier weight on the volatility of the price. And I think that's something we can go into. I mean, that's something that most people, if they don't look at markets fractally, miss. Again, they look at one thing, the surface area of the price or the momentum of the price. And then, like I said, we look at it across duration. So I'm not just looking at like trades or what I call 3 weeks or less. Trends are 3 months or more, and tails are 3 years or less. So if I look at a picture of what my signaling process is telling me, I'm not just like dogmatically or myopically looking at one duration, whether I want to be Mr. Long-term that day or Mr. Short-term that day. I'm Mr. every term all day, every day. And what I really care about is the changes in the volatility of volatility. So again, I care about the price, volume, and volatility and how they're interconnected, in terms of relationships. But I really care about moves in the vol of vol, or as Benoit Mandelbrot would have taught us in fractal math, that's the leading indicator for phase transition, or something to go from a bullish trend to a bearish trend. Those are the biggest moves, or conversely, from a bearish trend to a bullish trend. So a bullish trend would develop if volatility starts to fall away, and a bearish trend in something's price would start to appear if volatility the volatility of volatilities were to accelerate and break out to the upside. So those are the things that I'm really focused. I mean, I probably spend, well, it's an 80-20 rule at least. I spend at least 80% of my day when I'm looking at market data. That's what I'm looking at.
And the phase transition, is that most important because you believe they're the best trading opportunities when that happens, or do you see what I mean? Like when it changes and it shifts through, is that interesting because the start of that shift is normally one that continues? Or
yes, phase transitions always front run big quad changes. So when you think of like a phase, it's not unlike the weather. I mean, yeah, there's a big phase transition when summer turns to fall and fall turns to winter. But in markets, you don't get that nice, clock time. You don't get calendar time and clock time. It happens slowly, then it happens all at once. Or as Mandelbrot would say, it's volatility is quite often like Brownian motion. It's episodic and non-trending. It's doing nothing. It's just designed to make Ed and I talk about markets like we actually know what's going on. A phase transition is where Ed and Keith really understand what's going on, because you go from hot to cold, or from dry to wet, or you go from bullish to bearish, or from bearish to bullish. So that's what I'm really trying to do. And when you think about it, like in terms, like if I'm trying to front run the quads with the signal, it makes a lot more sense. I'm trying to front run a breakout in interest rates because that's quad 2. Okay. Now, front running that, well, that's pretty simple. I mean, buying treasuries, now you're going to lose a lot of money every time you buy them when they're down, because they're going to go down more. Same thing with gold or gold miners, and that's actually what started to happen most recently. Is that they've started to undergo what I think is just a very obvious phase transition, if I'm right on the next economic quadrant, and that's where the biggest money is to be made, because quite typically you have what I call latent late cycle positioning. So in other words, people are latently long, that portfolio because they're latently long deflation and they're not getting long inflation. Inflation from deflation is a phase transition. It's not anything else. So that's why I'm paying. So again, it's the signal front running the quads is critical.
Yep. And in these risk ranges, so you have, like you talked about, the multi-duration, which means you have different ranges for the trend, tail, and trade, trend, tail. If something goes through a trade line, does that mean the trend is still okay? Like, do you see what I mean? If it goes through those levels?
Yeah. Well, I mean, it's one or the other. A trade is either, if something goes bullish trade, but it's still bearish trend. Let's use, actually the 10-year yield in the US is a good example of that. It's bullish from an immediate term trade perspective, and it's about to go bullish on an intermediate term trend perspective. So so there's time and space in between those two. So it's one of two things. It's either a head fake, or the trade changing direction is the first shot or leading indicator for a phase transition or a breakout on a trending basis in interest rates. And I think if I didn't know what quad 2 was in this example, I wouldn't believe, like I'd say, okay, I've been bullish on treasuries for 2 years. I mean, I bought every bloody dip trade. There are many trade head fakes for 2 years, but there was no economic quad that was pending quad 2 that would say, hey, it's not just going to be a trade, it's going to be a trend. So does that, if that makes simple sense?
Yeah. And you talked about volatility. I just wanted to pick up that again, because I think that, most people don't look at that relationship with price and volume like you do. And that was really interesting to me. I mean, it makes complete sense when you think about it, but it's not something traditionally people look at a lot. And is it possible to just describe the relationship between realized and implied volatility and why that's critical to the market signal? Yeah,
I mean, the relationship between volume and volatility, or implied volatility versus realized volatility, they're all relationships within the same process. So let's do the volume piece first. So, and I'll just, not to be very immediate term about it, but just because these numbers are in the back of my head, because this is the number we're dealing with today, and it's by the way, if you're allowed to legally count cards, or you are legally allowed to fish with a fish finder, but if you were legally allowed to count the cards and there was only one deck or two, you could make a lot of money doing that over time. right? I mean, so I am counting the cards. So when I look at Friday in the USA, it was a down day for US stocks, but volume was down 9% day over day. And volatility was not signaling, anything that was a change from an intermediate term trend perspective. So it's still trend bearish on volatility or trend bullish on price with volume confirming. So that's one thing. Then I look at the options market where you see realized versus implied volatility. So realized, that's what's happened. That's what just got priced in. So the stock market in the US went down for 2 or 3 days in a row. All of a sudden, people start bidding up protection because they buy protection after things go down, and they sell protection after things go up. They're constantly chasing their own tail. So again, I fade that. So that's I also call it fading your feelings, or fading consensus, or fading the old wall. There's a lot of different ways to say the fade. But again, when there's an implied volatility premium versus what's been realized, people are more fearful, or they're trying to protect. When there's an implied volatility discount that's developed, it's typically, or almost always, after something's gone up a lot and people are taking off their hedges, they're buying calls, et cetera. So where you learn a lot, and I back tested this obviously as well, is that the most information you can find is in the 1 day versus the prior day, the 1 day versus the 1 week, the week over week, and then all that versus the last month. 30 days or less. So I spend a lot of time paying attention to 30-day implied volatility versus 30-day realized.
Yep, that's pretty cool. And just
a lot of information in that, because that's like to me, I wake up every day. It's like sometimes if I have the TV on, it's on mute, but you could see like people, their emotion, and it's quite literally, there are particular points in time where it's the opposite, like the setup of the market from a quantitative perspective on price, volume, and volatility, and the vol realized versus implied, is the opposite of what's coming out of their mouth. It's like it's raining cats and dogs, and they're telling you it's 90 degrees and sunny. It's an amazing thing to watch. I mean, God willing, I always say these people will be gainfully employed for as long as I live, because you got to have somebody to play against.
And that's essentially your market sentiment sort of indicator. Is that what you're using it as? Yeah.
Yeah, I mean, a lot of people, and that's a good thing. I think it's a good thing, and I don't mean it. I know that like Twitter is just words, right? And now you've been kind enough to let me talk so you can hear my voice. But I mean, it's not like I'm being mean to people. It's just I'm calling out like, hey, like you're just not aware. You gotta be, and the more people that are participating, like I think we're at all-time highs in terms of participation.
Oh, definitely.
Retail participation and whatnot. So there really is what my friend from former Goldman alumni, Buddy Carter, likes to say. He was a great follow on Twitter. He always says, you don't want to be the uninformed volume at the edges of the risk range. Like, you just don't want to be that person. Like there's a lot of different names for that, but I mean, and sometimes I use them. I won't in this conversation, but you really just don't want to be that person.
Yeah. And this sentiment, so they got the options market sort of sentiment, you're getting some insight on whether people are being fearful or complacent. How does that also, not compare, but you also talk about the Wall Street consensus positioning. Yeah. Use that as well. Like, how do you use that, and how do you find out that information?
A lot of this information too, which is why I think a lot of individual subscribers quite like what we do, is that you have to have a Bloomberg terminal first of all to even get it. Never mind contextualize it. Right? You could have all the information that I just gave, at least some of the things that I've talked about, but you'd have to get like CFTC futures and options contracts, non-commercial. That's the positioning of the market that I care about, because that includes on the margin what all the hedge funds and active managers are doing with their hedges. Okay. So, if I was just looking at commercial, that'd be different, but I'm looking at non-commercial. So here's a good one. Like, a couple for a couple of weeks, really. I mean, the narrative as opposed to the numbers on Wall Street was everybody's bullish, everybody's long, everybody's, In other words, I missed the move and I'm pissed off, and it's got to stop, and I'll buy the first dip. That's kind of, but if you looked at actually the net position in the S&P 500, and I'm looking at index and E-mini contracts, this morning it was negative 26,901 contracts. Like, it's a net short position, right? I mean, historically, to put that in context, when Wall Street is actually positioned bullish, position bullish. Those are numbers. That's not a narrative. The max net long position in the last 3 years was 271,000 contracts, plus 271,000 contracts. Okay, so there is a diametrically different position in the market relative to the narrative that's being just I don't know, I guess sold to you or whatever. So you got to pay attention to this stuff.
How does that? So if Wall Street's bullish, what does that mean?
Well, if Wall Street's bullish and you're at the top end of the risk range and you got deep and diving implied volatility discounts, you got to be selling more aggressively. Now, if today, when the market goes to the low end of its range and Wall Street is net short the actual market, because they're scared of a big correction, you got to be more aggressive buying the dips. And that's people have a hard time with that, right? Because they have, because they're like, oh, I read Zero Edge, and I didn't forget the H on that, and they've been scared. They've been scaring people since 2009, from the bottom. Yeah. And it's like that's not how you run money. You have to be able to, if you're going to be scared there, you should be excited over here. At least let's have some balance. And I think that that's quite typical, actually, in a phase transition. Just to bring it back full circle, don't forget that we had a recession, a deep one, and it ended very quickly in the U.S. this year. So people have there's a reason why people are fearful and scared. I mean, a lot of them are locked down in their homes with COVID. I'm not trying to to be insensitive to that. I had COVID. It sucks. But people really are, when they look at the daily market corrections, they're still living in fear, and that's where you can make a lot of money on the long side. To me, it looks a lot like, again, they're always the same, so they're not the same. But in terms of positioning, it's very much like the end of 2009 or the end of 2016. Actually, is a good one. 2006, because 2017, you just got killed if you're short stocks and long treasuries, for example. Yeah.
So potentially a lot longer to go in U.S. equities as long as the dynamic stays the same like that.
Yeah, I think at least 3 to 6 months, I reserve, just like any other flawed human being, I reserve the right to change my mind on that every day, and I do sometimes. And when I do, I don't mess around. I don't mince words. I just say, hey, look, it's not about being wrong. It's actually about changing. Because the only one who's really wrong is someone who decides to remain wrong. So if something were to change, then I'll change. I mean, that's the Bayesian process. If there ever was a thing.
Yeah, I know completely. So I just got a couple more things because I know I've taken a lot of your time already, but I just wanted to ask about position and portfolio sizing, your approach to that. Because as a thing, many people struggle with.
Yeah, I struggle with communicating it. I don't struggle with communicating exactly what I'm doing, and I think that, however, and that's one way, Ed, that I've had success this year. I think is in quite literally showing people what my positions are, from both an asset allocation perspective and then right down to the screws, longs versus shorts. So first, if you take an asset allocation model, I always say, fixed income is my largest asset allocation, so therefore the positions in fixed income are, I have no problem going to a 10% position in a fixed income position, for example. I have no problem taking up towards a 10 to 12% position at max. So again, I define everything at max. For foreign currency and gold, when I'm bullish on gold, I'll put that all in the same thing because I see gold as a currency. They max at 12. Fixed income maxes at 10, equity by position maxes at 6%, commodities max at 4%. So I'm just using, like the big asset allocation that you could have. The reasons why, the reason for the difference in size is the difference in historical volatility by asset class. So I'm going to, put more capital into something that's got lower beta and lower volatility over time, and I'm going to put less capital into something like commodities that have higher. Then when I look at the long short side of my portfolio, which would be like just take long stocks against short stocks, my longs are always going to be bigger than my shorts at the individual position level. And I also have rules. So I'll use there are two different kinds of portfolios. I use a 6% max long position where my medium-sized positions are 2%. And then I have a 1% position, which is a starter position. Or I'll have a 3-2-1 portfolio where my max is a 3% position, then 2, then 1, obviously. On the other side of the 3-2-1 long positions, I'll have 1.5, 1.5 in terms of positions. So, each of the shorts are actually half the size of the longs when they're side by side. And I've been doing it that way for a long time, basically because I'm a disciplined person. Like, again, I got a lot of issues, but one of them is not my work ethic and my discipline. And I think that's something that a lot of people struggle with because they just aren't that way in any other part of their life. So, I always encourage people, define what your max is and define how you touch each position. So I typically trade, like I said, 0.25 to 0.5% of my capital at a time, or 25 to 50 basis points. So that I'm constantly, averaging in or averaging out of every single position.
Okay. Yeah, very, very interesting. And the last thing I wanted to talk about is something you've been talking about recently as well. You believe factor-based index investing and the growth of market-neutral hedge fund strategies have made financial markets more sensitive to macro risk than ever before. Are you able to give us an example and describe a little bit about what you mean and why this is the case?
Yeah, I mean, the more capital that is using a rules-based strategy that mimics the machine, then the more.
Can you just for people that don't know, just describe what the machine is as well?
Yeah, the machine is basically all of those strategies that engage in the market systematically, quantitatively, rules-based. That would include a lot of hedge funds. So, up until this year, that could be on any given day 85 to 90% of daily trading volume. So I call that the machine. So what you want to do is front run the somewhat predictable behavior of the machine. And the machine, because people have to react. Like if you're running a long short portfolio for Citadel, and a major factor starts to move, well, you got to move, because you're supposed to be neutral. So the more and more people that attempt to be neutral, and the more and more people that are aware of the machine, then of course the higher probability for a dislocation when there's a phase transition in something that's gone one way for a long period of time. And that's why I actually think that the biggest risk in markets today is probably not the risk that most pundits are looking for. They're looking for some kind of stock market decline or whatever. I actually think it's a breakout in interest rates, and I've not been known to make that quote unquote call for a couple of years at least, because I was saying quite the opposite. But you have a lot of latent late cycle positions that are starting to get shaken out. I think gold's actually a pretty good example too. That's a good example of a position that people felt very comfortable with for a couple of years, and now systematically factor-based investors are going to sit there and say, wow, I don't like that anymore. And the machine, by the way, isn't a human being saying that. They're just doing that. They're just selling it. They're just hitting bids. Yeah.
How can people sort of combat the machine? I mean, so I suppose Hedgeye is there to help people do that.
Well, that's our main goal. So I don't. Our competition on this. I mean, don't forget where I came from prior to Carlyle was Magnetar Capital. Those are the guys that spun out of Citadel. It's not my first rodeo, like in terms of understanding how the machine works, because my job really for going back till I worked there in 2006 has been to front run the machine. And that's everybody's job on Wall Street. So I think as an individual or a high net worth investor or family office, you really need to be paying attention to that, because all the big money is paying attention to that. So when I look at like who people need to pay attention to, like I'm most interested not in what some person is yapping on TV about. It's definitely not them. It's the buy side. Is when is Renaissance Capital making a big pivot, or when is Bridgewater, changing their positioning? I mean, if you're not in front of that, you are going to wear that, and you don't want that. That's one way to think about that.
Yeah. Well, Keith, that's that's been like eye-opening. I think everyone who's listening to this will really enjoy and learn a lot from it. And I think the way you look at the markets is I mean, it's eye-opening in the sense that most of our people don't look at it in that way. That we've spoken to on the podcast, we've talked to a lot of people. So I hope you've enjoyed it too. I don't know if there's some way you want to finish. You can sort of introduce on how people might get access to Hedgeye and use it in their own trading.
Yeah, and I appreciate that. I mean, at a bare minimum, I am different. I've gotten comfortable with that too. But the best place to go is hedgeye.com. We actually have a lot. Hedgeye EDU, which is the educational component of the website, is all free. There's actually a lot of free videos. There's a lot of free, and then once you get comfortable with that, or you're interested, then sign up for a free trial for any of the risk management products or anything that's of interest, and then you go from there.
Brilliant. And obviously they can follow you on Twitter as well. Can you just remind us of the at Keith McCullogh?
Yep, that's the one. That's
cool. We'll have that in the show notes as well. So for anyone who wants to get that. But thanks so much, Keith. I've really enjoyed it.
Yeah, thanks for your interest. I enjoyed the conversation.
Was there anything you wanted to leave? Like any last words of wisdom or anything?
Just pay attention. That's all I got to say. Like, we all have to pay attention. But thanks for having me.
No worries. Yeah, no, thank you very much. Cheers, Keith.
Yep, cheers.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.